Hi, everyone. My name is Kishore Siva, one of the managing directors here in the US for Valenta, and we're delighted to welcome you to this week's edition of the Insider Series. Today, we're really delighted to have Michael Reeder joining us, and we'll be introducing him in just a moment. But before we jump into today's topic that I know everyone's really interested in at this point around year-end tax planning strategies, wanted to spend just 2 minutes sharing a little bit about who we are at Valenta. So when we think about Valenta's mission, we are absolutely committed to helping our clients focus on their core mission. And what we want is our clients to be as efficient as possible and improve their processes. And we do that through consulting, digital transformation, automating tasks, and staff augmentation. Valenta's globally has offices globally with over 550 team members across multiple countries, including the US, Canada, all through Europe, Asia, Africa, South America, and Australia. And if you don't know your local Valenta franchisee or managing partner well, ask us and we're happy to introduce you to them. So as a business working with Valenta, what are some of the benefits that our services across consulting, digital transformation, automation, and staff augmentation, what can they actually help a company with? Well, cost savings is a significant benefit, improving customer service, quality of work outcomes because you can leverage a globally outsourced team, boosting employee morale because you can have your key people working on the tasks and activities that are more value added and enjoyable, as opposed to the administrative repeatable tasks, and ultimately increasing profitability and further driving business outcomes. And Valenta's client base cuts across multiple industries. We have expertise across a variety of industries at Valenta, and we're able to help companies and have helped companies across each of these industries and more achieve improved process efficiencies and profitability. So why are we here today? Today is actually our a really exciting session of the Insider Series. And so the Insider Series is a series of sessions that we started last year where we're bringing in experts across multiple fields to talk about topics that are near and dear to business owners. And all of our Insider Series from past sessions are available on YouTube, and please take a look at our channel and subscribe to it so that you can hear future episodes and see future episodes. In addition, we are going to start the Insider podcast, and this will be the first of our sessions that will actually be released as a podcast, so you'll be able to listen to this on the go as well. So now, most importantly, the reason we're here, and really it's to have a conversation with Michael Reeder. And just to introduce Michael, Michael is the managing shareholder of Swartz Reeder Advisors and is the lead advisor for clients across multiple services, including business buying. And he's versed in all things accounting, tax planning, entity structure funding, financial projections, reselling, financial statement due diligence, franchise disclosure. Michael has a lot of experience with franchisees and also with business owners that are not franchisees. Michael also helps business clients prepare for exit strategies and mitigate capital gains taxes as well. He is an active affiliate of the Franchise Brokers Association, the Franchise Consulting Company, the U Network, the International Franchise Professionals Group, and the Illinois CPA Society, amongst others. So we are absolutely delighted to welcome Michael, and we've known Michael for some time now, and he's been able to help many of our clients as well. So Michael, as we get started, I'd love to have you tell us a little bit about your background, because when I look at the Swartz Reeder Advisors website, I see that Swartz Reeder Advisors has been in business for 45 years and is a leading firm in this space. And I'm guessing that you have not been with Swartz Reeder Advisors for all of those 45 years.
Absolutely. Well, Kishore, first off, thank you so much. Second, you're absolutely right. I'm 35 years old, so you can do the math. And I don't think people want like a little 2-year-old, giving them advice. But yeah, so it's great to be here. So grateful for the opportunity, and thank you to Team Valenta, and real. You were saying I do know a lot about all the stuff that you mentioned, and I also have a great team. I one of the great things about Swartz and Reader Advisors is we have a lot of great team members that bring a lot of value to the table. But Swartz, right? So Reader, right? Michael Reader is 35 years old, but Barry Swartz is in his 70s, and he's still working full time. And he's been a CPA since the 1960s, and he had his own firm in the 1970s. And I met Barry right out of college in 2010, and self-studied for the CPA exam those first couple of years. I became a partner in 2015, and acquired the business outright in 2019. But Barry is still working full time. He is my mentor in the industry. I'm very grateful to have him in my life. I consider him a second father, and he's taught me the ropes of the industry. And I really, Barry has been working with small business owners and individuals for decades, and we're still working with grandchildren of original clients. But I've really cultivated out this niche working with business buyers and the franchise industry the past 7+ years, and it's been super fun.
Excellent. So, the topic at hand today is about year-end tax planning. And when we think about business owners, and we have a number of business owners that are attending today, why do you find that proper tax planning is so important for business owners?
Yeah, absolutely. It is, because it's so important for business owners, because there's so much that goes into it. When you are a business owner, when it goes into it, and what I mean by it is tax planning. When you're a business owner, and or self-employed in the eyes of the IRS, there's so much that goes into that compared to if you are not self-employed and you are you're an employee, whether it be at a corporation or in the government, et cetera. And for the latter, you may make a lot of money, but your tax filing may be pretty streamlined. You may make 6 or 7 figures on a W-2, but it's still, entering in a W-2 with 5 zeros on it instead of 4 zeros or 6 zeros. It's still entering in a W-2, and some mortgage interest on a house mortgage and some property taxes. Could be pretty streamlined, and someone can feel they can easily do that themselves on TurboTax. But in my humble opinion, and obviously being in the industry, it is clear to see that the tax code is written for the self-employed. There are several chapters of the Internal Revenue Code that open up, that are at the disposal of self-employed taxpayers, whether they're business owners, solopreneurs, both. And there's so much there, and it's so important to tax plan, because it's always it's something that you as a business owner want to be in dialogue with your CPA and team of trusted advisors throughout the year, as opposed to doing last minute scrambling. Of course, if they're we are on December 10th right now, and so there's always some sort of degree of last minute scrambling going on this time of year. But the business owners that are proactive and planning throughout the year are not doing that. And there's so much to unpack. That there are so many things that could be beneficial to business owners from a tax planning perspective, from a tax mitigation perspective, that it's really important to have that ongoing dialogue throughout the year, instead of just last minute. And then once you're past the year, and so for example, if we're into Q1 of 2022, and you're a business owner and you're getting all your stuff ready for your 2021 taxes, there could be several strategies that are no longer available because you're already in the new year.
Yeah, no, that you're so right. So, and one point I was going to make earlier is, for our attendees today, please feel free to ask questions as we go in the chat, and we'll be sure to answer those at the end as well. So you talked about year-end tax planning, and it's really important to be organized. Not every business owner keeps the best of records. Can you talk a little bit about why it's so important to keep those records in good stead? And do you have any horror stories from your experience where someone maybe didn't do that?
Yeah, absolutely. And it's amazing, Kishore. The majority, if you were to read books like, the E-Myth Revisited by Michael Gerber or Profit First by Michael Michalowicz, those are just two examples of, just like no matter like the majority of small business owners don't keep good records. The majority of small business owners out there, when like they view and I have empathy for all of them, because they view bookkeeping as this thing that needs to get done to get taxes filed.
Right.
And that's it. And it's like, oh, it's February of 2022. Let me get my 12 months of bank statements of 2021 over to my accountant so they can punch them up but small business owners, unlike, big corporations that have, different departments and, an army of internal accountants, et cetera, small business owners are often wearing several hats, and they have families, and so at the end of the day, or so I am empathetic as like I completely understand why several small business owners fall into that trap and they never get around to it. But it's so important to do it, to get around to it, because keeping records, right? So having an accurate and perpetually updated set of books is the foundation for any business owner. You can't have a tax planning conversation for a small business owner. A small business owner and his or her CPA can't have a substantive tax planning conversation if the books are never correct, if the books are never updated, or if we're always, trying to get the books updated and we're always, 6 to 12 months behind on that. You can't have a cash flow and profitability conversation, AKA like a CFO geared conversation if the books aren't correct. You can't really do any planning if you don't have anything to look at. And so that's why so just having a clean and accurate set of books that's perpetually updated, if not daily, weekly, at least monthly, just because that accurate and updated set of books is the foundation of all the planning conversations, the tax planning conversation, the CFO conversation, profitability and cash flow, which tax planning is part of, but not which tax is part of, but not all of it. And then also, if you again, the Internal Revenue Code is written for the self-employed, but if a business owner were ever to get audited, the whether that business owner is going to survive that audit or fail miserably or somewhere in the middle, it's all going to come down to the strength of documentation. And so there is more legwork that goes into compliance when it comes to tracking your income and expenses compared to just being a W-2 employee where you just have your W-2 and your 1098 for your mortgage, interest, and property taxes and some charitable donations. There's more legwork that goes into the record keeping aspect of it. But if you get that down pat, then you can not only maximize the tax deductions available to you that aren't available to a corporate employee, but also if you ever were to get audited, you have the proper documentation to survive that audit. And speaking of just one that comes top of mind is just a client who was a new client of mine at the time. When we were working on his, like he first came to us for his 2015, but the IRS was auditing him for 13 and 14. And he was a solopreneur consultant. And, I think that he self-prepared his taxes. Maybe he had like a representative from TurboTax help him, but he had a sole proprietorship, and he had just tons of travel expenses and meals, and they were high in proportion to the income that he was making, and he didn't have he ended up going on a payment plan with the IRS. Like we were able to substantiate some of it, but not all of it. And he ended up owing a lot of tax, and there were penalties and interest on top of that tax. And it was a combination of him just not being prepared, and also being advised by someone that maybe didn't advise him correctly. But it's just, if he were to have everything in order, then he would have survived that audit, if not, pass with flying colors, at least maybe just have a few things that were to get added back to income. But he really, the substantial amount of his expenses, auto expense, travel expense, meals, entertainment, just didn't count at all because he had no proof to back him up.
Totally makes sense. When you think about where we are in the year, you mentioned December 10th. It's hard to believe we're only 3 weeks away from the year end. And so a lot of business owners are now thinking about some of their year-end tax planning strategies. What are some of the deductions that are really important for a business owner to be thinking about at this point in the year?
Absolutely. So great question. So really, retirement plan is always a big one. So self-employed retirement plans, whether it is a 401k, a SEP, or a simple IRA, the retirement plan, the self-employed retirement plan is a great strategy that can be implemented. That a self-employed business owner can have a lot of max contribution flexibility compared to just being limited to what their 401k at work is offering. 401ks, you can put away, depending on your age, you can put away 19,500 or 26,000 out of your earned income, in addition to up to a potential 20 or 25% profit sharing of your earned income. And so between the two of them, depending on your age, can be around $58,000 or $64,000 each year for one person. SEPs and simple IRAs are not as large in the context of contributions allowed, but they're still there. That's in addition to what you can potentially put into an IRA. And even if your IRA, depending on your earnings, is not deductible, you can still do a non-deductible IRA contribution. And something that is, with this new infrastructure bill that's coming down the pipe, I'm sure a lot of people listening today have heard of this thing called a backdoor Roth, where you contribute to a Roth, a traditional Roth, and it's non-deductible, but then you immediately convert it into a Roth. That's, with this infrastructure bill, if everything goes through as they're talking about, then that will go away effective 2022. But retirement plan strategy, Kishore, is a key thing that should always be getting discussed with business owners this time of year, because several business owners, like if they're making money and they've written off the majority of the things that they needed, and they still have this profit, it may be the time to implement a retirement plan, and you have until the end of the year to do it. So retirement plan strategy is always something that's being discussed, with me and my team and our clients always, but especially during this time of year. A lot of small business owners are structured as a sole proprietorship or a partnership. And, they could be, and they've been ramping up their business. And like 2021 could be the first year where they've made a substantial profit, and they could benefit by saving self-employment taxes if they were to convert their sole proprietorship or single member LLC or partnership or multi-member LLC to an S corporation for tax purposes. All of those former entity structures that I just railed off right there, the net income from those entities is subject both to income tax and self-employment tax. Self-employment tax is a 15.3% tax. It's another term for Social Security and Medicare tax. And all of that net business income is subject to self-employment tax. But when you're taxed as an S corporation, you take a portion of your profits as salary, and you pay the payroll taxes, the self-employment taxes through the salary, but the remaining amount of the S corp profit is not subject to self-employment tax. So that's always something that we're looking at with our clients. Is this the year to convert their LLC or their partnership or their sole prop to an S corporation in order to save money in self-employment taxes? Fixed asset capital expenditures. There are, so we are in the, Kishore, Valenta, myself, and my firm, like we're in the franchise industry, and a real common thing in the franchise industry is the franchise fee. And the franchise fee is what's known as a Section 197 intangible asset. So what does that mean in English? What that means is that has to get capitalized as an asset and amortized over 15 years, regardless of what the life of the territory is for that particular franchisee. But there are other capital expenditures out there, furniture, fixtures, machinery, equipment, there are and then also vehicles, and depending on the type of vehicle, but all of these things that, these fixed assets qualify for accelerated depreciation. That could be a great thing, if a business owner is in need of these things now, and they're going to invest in them anyways in the first couple quarters of 2022, it may benefit them to do it now in order to take the accelerated depreciation in 2021. And have it reduce their 2021 taxes, as opposed to 2022, where the year-end planning, we're still a whole other year away from that. So we're always looking at this time of year, Kishore, with our clients. There's always nuances for the clients, but really, I mean, retirement plan strategy is always being looked at. Entity structure and the feasibility of converting to an S corporation is always being looked at. Capital expenditure investments that are, I mean, we don't want business owners to invest in a big piece of machinery just for the write-off, if it's just going to sit there and collect dust. If there's a viable business need for it, if they legitimately need another truck for their home service business, if they legitimately need a trailer for their for their spray net franchise, which is a painting franchise. I'm just thinking out, if there's a legitimate business need and they're going to do it anyways, might as well do it now. And just because, and so what's cool about the capital expenditures is about the capital fixed asset expenditures is you don't necessarily have to come out of pocket all cash for it. You could heavily finance it. There are great equipment loans that have great rates that so you can heavily finance something, come out of pocket, 10 or 20%, sometimes 0% out of pocket. And you can still, if you take ownership of it, even if it's heavily financed, you can still benefit from the accelerated depreciation. So that's a nice win-win situation there, because you can benefit from a great chunk of depreciation and keep your cash position strong. So, just because you need to make a capital expenditure doesn't necessarily mean, like in a fixed asset, doesn't necessarily mean you have to come out of pocket for the entire amount with cash. What are the financing options? So that's always something that we're looking at with clients as well. We're always looking, depending on the basis on which the business reports their taxes, they could benefit from the acceleration of expenses and the deferral of revenue. So again, if there are expenses or ordinary expenses that they're going to incur anyways in Q1 and Q2 of 2022, can they pay them, if they report their taxes on the cash basis, can they pay them now?
Right.
Accelerate the expense. Can they communicate with their clients and maybe perhaps defer the revenue into 2022 instead of taking it and recognizing it in 2021? So acceleration of expenses, deferral of revenue, always looking at that. It's amazing, again, small businesses, like things that come up in conversation with clients, several clients out there, they may legitimately have their spouse and or their teenage aged kids, their teenage kids or their kids in their 20s that are helping them with miscellaneous administrative tasks of the business and or marketing tasks of the business. I think we can both agree, Kishore, that that it's most likely that the teenage aged kid most likely knows more about like the social media marketing landscape than we do, right? So but so it'll come up in conversation with clients, and okay, so your spouse and or your kids are helping. What about putting them on the payroll and giving them a part-time salary of $10,000 or $15,000? Like if they weren't doing anything, like okay, there's some gray area there, and depending on who you talk to and how aggressive they want to be. But it's amazing how many people do have their spouse and or kids working on some aspect of the business, and it could be justified to put them on the payroll. And then if you could, find justification to give your kid or your spouse a salary of $15,000, for example, to justify some part-time work, then you're shifting income from, your tax bracket, which may be in the high 20s or the low 30s, the low to mid 30s, over to your kid's tax return, which may be 0 or 10%, for example. And then also, but then also the spouse may even work more than part-time, and they could be viewed, they can be full-time. They even may qualify to be part of the retirement plan. And now you can make contributions not only to your own self-employed 401k, for example, but also, your spouse can be an eligible participant. And so, between the, like depending on the income, there's a potential for over $100,000 just, and that's just 401k. Depending on free cash flow, there could also be, what I mentioned earlier, we're known as, the common defined contribution plans, right? 401k, SEP, simple, but there's also pension plans. There's also defined benefit plans, which are, whether they're cash balance plan, defined benefit plan, pension plan. These are, these can be stacked on top of your traditional 401k, for example, depending on how much free cash flow the company has, and the business owner can put even more into retirement. So there's just so many things there to unpack. There are so many, like, regardless of the client, there's IRA contributions, there's HSA, health savings account contributions, there are 529 contributions, for the kids' education plans. There are so many things that really, regardless of, I don't even have to know the details of a particular client, because every client has their own nuances specific to them. But without even like I can just go into a conversation and just go down that checklist of those things that I just mentioned, and chances are 5 or more of them would apply to any particular client, especially if they're a business owner.
So Michael, a couple of follow-ups to what you just went through, a lot of information, which is terrific. In fact, when I go back and watch this video, typically when I watch a video on YouTube, I watch it at 1.5 speed, just so I can watch it quickly. I'm going to do the opposite on this one. When I go back and watch it, I'm going to watch it at 0.75 or 0.5 speed, so that I can make sure I pick up on everything that you just said, and make sure I didn't miss anything. But
you can blame it on the double espresso that I had before.
No, this is just, there's a lot there, and a lot of really great information you just shared. So a couple of things. You mentioned the putting kids on the payroll. That one piqued my interest because I have a 13-year-old. But one of the things I was wondering about, is there an age limit to being allowed to do that?
So, labor laws vary with the states. And I believe that there, you could have, and again, if I like to, as a general rule, I like to, I like to consider teenage kids and older, just because, you can legitimately see a 13 or 14. I know I was working at 13 at the local pool, the snack bar. But there are situations where the client has a legitimate argument where their 1 or 2 or 3-year-old kid is, posing in pictures that they're using for marketing and stuff like that. And I've seen it before, and there are articles out there about how to properly do it in terms of to take the write-off, and they're justifying giving the kids some sort of earned income, and then they're contributing to their kids' Roth IRA. If anyone's going to do something like that, they got to make sure that all their ducks are in a row, and that it's legitimate. If you're going to give a 3-year-old some sort of paycheck, you have to make sure that you do your research, not only talk to an accountant, but also talk to a labor law attorney as well. And labor laws vary by state. There are if you're structured as a sole proprietorship, so not as an S corp or an LLC or or a partnership, et cetera. If you're structured as a sole prop, you could potentially pay your kids a reasonable compensation, just call it $15,000, for example, in a sole prop, and not have to pay the Social Security and Medicare taxes on it. If you structure as an S corp, then that doesn't apply. But there are certain perks to put your kids on the payroll if you're structured as a sole prop and not have to pay the Social Security and Medicare taxes on it. So that can be an additional incentive. But with age, really my when it comes to age, it's definitely gray area. and it's definitely something that you want to, like, if you're gonna, if you're gonna put kids on the payroll that are like, younger than teenage, and they're doing any, like, and it's outside of like the scope of like general, it's something that's kind of like, crazy. Not saying that it's impossible or can't, or it's not legal, but if it's anything that's like really maybe like, in the eyes of some people, maybe pushing the envelope, just it's all a matter of just making sure that you do the proper research and not only talk to your CPA, but also talk to an attorney. And labor laws vary by state.
Okay. So that raises a really interesting question, right? What are some deductions that you see business owners trying to submit that you have to go back to them and say, yeah, you're not going to be able to do that?
Right. Absolutely. I mean, the ones that come to mind are meals and entertainment and auto and home office are like the core ones. Not saying that you can't take any of those, but clients tend to want to take more than they really should. I can't tell you, like, so the home office, right? The home office is the IRS. Now, again, like, I'm the IRS here, right? And so I always just tell the clients, well, this is the IRS's position. Like you have, like, if the IRS auditor were coming to your house next week to audit your home office expense, you're going to have to show them a room in the house that is dedicated to being your home office. So a home office cannot double as a personal room in the eyes of the IRS. I can't, I always have to be the bearer of bad news when I tell the client, your kitchen does not count as your home office. Your finished basement does not count as your home office. Your living room does not count as your home office. Therefore, because they're trying to find justification to take the square footage of their finished basement, and to, and like all of a sudden their business use percentage of the square footage of their house is 35%, like that's just big red flag territory. And so, generally, a room that is a legitimate home office. And so generally the square footage of that home office divided by the square footage of the entire house, usually tends to come in around 5 or 6%. Okay. 7%, maybe, it could be more. But when it starts to get to like, 20, 30%, that's pushing the envelope. So home office is a big one. Automobile, if you want to write off your automobile, whether you go mileage, so when you go automobile, you can either go mileage or actual expenses. But if you go mileage, you have to break down your mileage between commuting, business, and personal. And you can only write off the amount that is allocated to business. So personal is like going to the grocery store, doing stuff that's not business. Commuting is waking up in the morning and driving from your house to the first place of business. And then all the other stops that you go that are business throughout the day, that's business. And then on like where you are on the last stop of the day to the way home is commuting again. So a lot of clients, think that their commuting miles are business, and it's not. I've heard all things. It's like that, is it Farmers Insurance with that commercial slowly with that jingle, which is like, we know it all because we've seen it all. It's amazing how many I've heard it all. Well, Mike, when I get out of bed in the morning and walk to my office downstairs, is that my commute? And then I get in the car and I love the creativity and I can see the reason in it, right? But like, again, like the IRS would say, no, that's not. And then also the record keeping when you go the mileage route for automobile is tedious. Again, like if you were to get audited for the mileage, the IRS would say, where's your log that shows the breakdown of all, and so many, like, I mean, again, like I've heard, I've heard how the clients, they tell me stories in the past where they're working with a previous accountant or this, or they weren't, and that they had to come up with their log, like, the night before the IRS auditor was coming. And then when you go actual expenses, you have to, again, the actual expenses is based off of your mileage. Meaning that you're not using mileage, you're using actual expenses, but it has to get prorated by the business use. So if that vehicle is really only being, and so just a lot of clients really, like they'll take 100%. If there's a vehicle that's doubling as a business vehicle and a personal vehicle, then you have to back out the personal aspect of it. And a lot of, so that's something that is a common thing that we're talking about. You can't write off the whole thing. Let's see what is legitimate to write off and what's not. And, where's that gray area, but then like, where does it start to enter that red flag area? Meals, a lot of aggression with meals, and we have to scale clients back and stuff like that. But those are the big, travel. And these are all commonly audited expense items that the IRS are like, this is low hanging fruit for the IRS. Like they'll audit. Go ahead.
No, I was going to say, sorry to interrupt, but I was going to say you bring up such a good point with meals, right? This time of year, especially, a lot of business owners are maybe taking out key clients, or maybe if they have team members, their team members, or business partners out for dinner or for lunch or what have you. What are some of the rules of thumb to kind of keep in mind so that you don't put yourself in the crosshairs of the IRS later?
Yeah, so meals can, like, there's like with this the Consolidated Appropriations Act that passed last December. Meals are actually, like, business meals are 100% deductible for 2021 and 2022. Then they go back to 50%, which is the usual.
Okay.
And that's in an effort to, drum up business with restaurants that have been, impacted by the pandemic. But
Mhm.
but business meals have to be like business meals, where, the main purpose of the meal is a business. It's like if you're taking out your kids to, like, Chuck E. Cheese's, and you want to write, like, that's not, you can say, oh well, like, we took the kids out to the Chuck E. Cheese and we talked about, me and my wife talked a little bit about, like, some business. Again, like, that's it's got to be, Kishore and Mike went out to lunch at the local steakhouse, and we talked about, strategic initiatives between Valenta and Swartz Advisors. Like, that's a business expense. you know
Yep.
uh, Kishore caters in lunch for his, like, team at the office, and, like, the office has a little office party. Like, that's a business expense.
Yeah.
Like, so it has to be a legitimate business expense, and there should be some sort of record documentation for it. I would go above and beyond just the bank statement. I would actually have a receipt and write on the receipt, like, the date and, like, what the business was, because that will only help in an audit. If you just showed the IRS auditor, like, oh, here's my credit card statement, and you see that thing, like, that Maggiano's, that was me and Kishore, and, like, the IRS would say, like, well, how do I, like, this is not enough, but, like, here's the receipt from that day as well, and it showed, so the more documentation, the better. But
Okay.
yeah.
That makes sense. So as we get to 1231, there are some year-end decisions that have to be made by a business owner prior to 1231, and then there are a few that you can make after 1231 and still apply to 2021. Can you talk a little bit about what falls into each of those categories?
Absolutely. So, retirement plans have to be in place by the end of the year. If you're going to make a capital expenditure in a fixed asset, it has to happen by the end of the year. So that's one. But then also, for example, if you are, for example, like, I'll backtrack on the retirement plan, because that can be unpacked a little bit. For the most part, retirement plan contributions have to be made by the end of the year.
Yeah.
However, IRA contributions can be made by April 15th of the subsequent year. That's not, that's an IRA. That's not an ERISA plan. That's an IRA. But also the profit sharing contribution to a defined contribution plan, where, a 401k a 401k profit sharing plan. The profit sharing piece can be contributed in the subsequent year, as long as it's contributed before the business tax return is filed. So, an S corp owner, if they contribute, if they make a salary deferral piece, the 19,500 that comes out of their paycheck, that has to be in by the end of the year. Or, like, a couple, if the last check date of the year is 12/31, it has to be in within a couple days in January. But then that S corp is not due until March 15th of the subsequent year. If they go on an extension, it's not due until September 15th of the subsequent year. And that profit sharing contribution can be made in the subsequent year, either right on March 15th or sooner, or even if they go on extension until September 5th, they can potentially not make that profit sharing contribution until September 15th of the subsequent year. And that write-off will still go towards the, in this context, the 2021 tax return, even if it was made on September 14th of 2022, for example. So, for example, if you do have a client, if you are in the new year and they already had a vehicle, and it was later determined that that vehicle actually is a business asset, like, maybe they contribute, maybe they didn't think about it throughout the year, but then in due diligence, working with their tax professional, they realize that they actually did have like, they may already have owned that vehicle, but they determined later on that it was a business asset. And so, they could come to that determination, if they already owned it, like you can have a client that has a vehicle that for years was personal, but they just started using it for the business, and they didn't really, and they didn't really, get around to writing it off at all until like they owned their business. So like that determination could be made in the subsequent year, and they can decide to, write off a portion of it through depreciation, for example. So those are some common situations that of examples that have to be before the end of the year, and some things that can be after.
Terrific. So Michael, when you start working with clients, what is your process? What is a process that a CPA should be using with someone that's actually either a new business owner or a business owner that is, maybe using your firm for the first time?
Yeah, absolutely. So I always ask for the client's permission to be a pain in their butt. And what I mean by that is that we're going to ask them a lot of questions. We're going to be proactive, and we're going to, bring a lot of things to their attention. And we're not trying to be annoying. There's just a lot there, and we want to be proactive. And really, I want clients to know that, like the services that my firm provides can be broken down between compliance services and advisory services. So compliance services, income tax prep, bookkeeping, payroll, sales tax, those services that that the average person out there thinks that any CPA does. But advisory services are more value add services. So advisory services are where we latch on to the client as their virtual family office. If they own a business, then we provide CFO services, exit planning consulting, whether they own a business or not, doing advanced tax planning throughout the year, bringing the necessary specialists to the table if they don't have them already, such as investment advisors, CFPs, insurance professionals, estate planning attorneys, and so what the advisory services are built for are those clients that really want that for that relationship client, that client that wants that ongoing relationship with, that sees the value in working with a CPA beyond simply just filing taxes. And that's what the advisory services are built for. And that proactive planning, and that's what that is all about. But there are several clients, clients are either going to see the value or they're not going to see the value. Clients also may be in startup mode and ramp up mode, where the advisory services may not make sense now, but maybe they would be, 3 to 5 years down the road, when they have like an EBITDA of 300,000 or more and they can afford it. But like, so for the clients out there that are like, Mike, I appreciate all the proactive stuff, but please just like do my taxes during tax season, send me an invoice and leave me alone. Of course, we can cater to that client, but we're seeing more and more clients, they want more from their CPA firm. They want planning, they want advice. And that's really, people see the CPA after my name. And a lot of people, like when a lot of people hear CPA, they think that's a person that does that prepares taxes and does bookkeeping. Does Swartz and Reader Advisors do that? Of course. Do we do a good job of that? Of course. But there's more to our firm than simply just preparing taxes and doing bookkeeping. I really am a trusted advisor and a business strategist for my clients. I am having strategic planning conversations with clients throughout the year, and I preach it over and over again to clients. Especially to that client that is having it I try to work with clients to get their bookkeeping system, fully functioned and optimal from the get-go, because we can't be in year 3 and we can't we can't get and the books are always behind a year. It's like, we can't add value to the clients unless we actually have, a perpetually updated set of books. So for those new clients, I really just try to, I try to, explain to them the difference between compliance services and advisory services. And, and if a client sees the value in advisory services, like early on, and they want to do it and knowing that it's a bigger investment, then by all means. But I also always put myself in the shoes of the client. And I say, hey, let's start out with some compliance and some light planning in year 1 and year 2 as you ramp up. And then, just know about this. But no matter what, like the income tax return is always going to be there each year, at least, at the very least, some light planning, if it's not quarterly, at least biannually, or definitely at the end of the year, for those clients that are in ramp up, that are new business owners. And then I always try to work with clients to get their bookkeeping system optimized, whether they're going to do the books or we're going to do the books. Spend 2 to 3 hours at the beginning to just get it optimized in the context of automation and technology. And there's, like Valenta knows all about that. That's one of like Valenta's key core competencies. And so I'm preaching to the choir, like with Valenta, like we all know, like Valenta and SRA, like we know, got to have it's 2021, it's about to be 2022. If your books, if whoever's doing the books is doing everything manually, like you're already behind the 8 ball.
Yeah. Having a robust financial position is so critical, and having a robust operational process is so critical. That's why I think our firms can certainly work hand in hand to help a business do that. We're right about time, and thank you, by the way. We got some nice comments in the chat. Thank you for that. One question that we got beforehand that I wanted to raise. So, and it also ties to something you were talking about year-end decisions. How does a deduction get treated if you write the check in mid to late December, but the vendor doesn't actually deposit it on their end until after the new year? Can it be considered a 21 deduction, or do you have to consider it 22 because the vendor didn't cash the check in time?
No, I would, the cleared check. So first of all, I'm assuming in that situation that the check was written in December, and it has a 12, 20, 21, on December 20th of 2021, it was written. And then for one reason or the other, it got dragged in the mail, and the vendor got it and they sat on it and they didn't cash it. To me, for the actual payer of that check, the company that wrote the check, I'm taking that deduction in 2021, even if it doesn't show up in my bank statement, and it doesn't show up until my January 2022 bank statement. The image of the check is still going to be showing a date of 2021 written on it, and also it's going to, so it also is going to show up in it's going to show up in the bank rec for December 2021. It's going to reduce the cash balance on the books. Right. And it's just showing as an unclear transaction in terms of the bank rec and on the bank. But I would definitely take that check in 2021 for sure.
Excellent. Thank you, Michael. So let's go to our last slide, which is really how to, if anyone has follow-up questions. You shared such fantastic information, Michael, and I really am going to go back and watch this again, probably more than once. But if anyone wants to reach out to Michael, you can reach out to him either via LinkedIn, via phone, via email, also through the Swartz Reader website. There's several ways to reach out to him. And similarly, if anyone wants to reach out to Valenta, and if we can be helpful to you in improving your business processes, or if you want the opportunity to think about working with us and open a Valenta office in your area, please reach out to us, and we're delighted to have that conversation. Thank you so much, Michael. Really appreciate it. Thank you to everyone who joined us. Really good turnout today, and look forward to being in touch again with everyone soon.